at the same time. So I want to thank you all for being here today, and I want to tell you our topic. So my name is May Doldelau, M-E-Y, May Doldelau, and if you're on Instagram, that's the name of my channel. If you're on YouTube, you don't know my name, so May Doldelau, because the name of my channel on YouTube is Creative Abundance Now. Today we're going to do chapters 15, wrong paper. That's really funny. Okay, we're going to do chapters 19 and 20 of The Intelligent Investor by Benjamin Graham. So 19 is called Stockholders and Management's Dividend Policy, and chapter 20 is Margin of Safety as the Central Concept of Investment. My name again is May Doldelau, and my blog is yesfinanciallyfree.com. Go there if you haven't done so already. Put your first name and email address on the right side, and you're going to get emails every time I go live and every time I do a blog. All my blogs are super informative. They're educational, and they're for regular people, okay, for anyone. So you can start out knowing nothing about money, and my blog will help you learn about money, okay? So it's written for common people, all right? I'm not a financial advisor. I'm a mother. I'm a full-time mother, part-time blogger, and finance freedom coach. So let me tell you a little bit about my story so you can get an idea of who I am, why I help people who are just normal, everyday people. And I understand people. So let's talk about this. First, understand me. Back in 2011, I had so much debt, like over $40,000. To some of you, that might not be a lot, like if you're Donald Trump. But for other average people, and at the time I was single, I was working a bank job, I was an assistant. My salary was less than that. Yeah, I made like $34,000, $35,000, somewhere in there a year before taxes were taken out, guys. Okay, so I didn't actually make that much. My debt was more than my annual salary. All right, and I had to pay for things with that salary. So that's a huge debt for me. What did I do? Well, instead of focusing on the negative and the debt, I decided to focus on what I wanted. And I chose to be financially free. And I've been focusing on that for a while now. I think I really chose it in 2009, around then. But I still hadn't seen great results yet, although I was learning what to do. I focused on passive income. I focused on net worth, because net worth is the true measure of wealth, right? So I started tracking those numbers. I started paying myself first. Every time I got a paycheck, I'd put money aside for me first before I paid any of my bills, even if I couldn't pay my bills. I started doing things radically different. So what happened? Well, my life radically changed. We improved by 2016. In April, I was debt free. In December, we had improved our net worth by $500,000. Okay, and we didn't make that much in salary. My salary was still the same. Okay, guys, like $35,000. Improved our net worth. I got married in 2012. Had my son in 2013. So he was 3 years old by 2016. Improved our net worth by $500,000. Passive income, we were making about $500 a month in passive income. And I quit my job. And became a full-time mother. All right. Still part-time internet marketer. Okay. But I started a different side of my business. I started coaching finance freedom masterminds. And those are groups of people who get together, and their sole purpose is to become financially free as quickly as possible. So I started organizing groups, 3 groups, paying clients, learning how to become financially free. All right. 2017, I went on a month of vacation. I went on a cruise to Mexico, which was a dream of mine. I'd never gone on a cruise. I had been visualizing going on a cruise, so I was excited to finally go. Went to LA to visit my husband's relatives and my friends. Washington, D.C. to visit my sister. Toronto to visit family on my husband and my side of family. Niagara Falls. I got to show Jordan Niagara Falls. He'd never seen it. I was really happy to share it with him because I grew up in that area of the country. And then, yeah, that's pretty much it. That's a lot of places. But anyway, Buffalo, New York. I visited my auntie and uncle. Hadn't seen them in so long, over 20 years. It was a great trip. And that was 2017. We also bought a condo for ourselves to live in 2017. We bought a second one in 2018 as an Airbnb business. When we converted the first one into an Airbnb business, had two businesses, sold one to our manager. We trained our manager. We had two managers. One was my mom, and one was one of our mastermind members who I trained to be a manager. I sold it to him. So now he owns his own investment property. And we used the money to buy this condo, our third purchase in 3 years, in Waikiki, 2-bedroom, really close to the beach, just 2 blocks away. It's really nice here. It's quiet. If you've seen my other live videos, there's always traffic noise. This one is like, I have my window open. It's quiet. It's just so nice here. I can't even explain how wonderful it is. So I shared that story, okay, of my life to you because I want you to understand that no matter what you're going through, and it doesn't matter, you know, I started my journey during the housing crisis, right? And it's now COVID-19, and I'm so much better off financially, health-wise. It's like so many things have improved in my life since then. So you can take your life and you can change it. It doesn't matter what your situation is. It doesn't matter if you know a lot about money or a little about money. I have been training mastermind members for years now, and I've noticed that a lot of people have lost their basic knowledge of math, all right? Because a lot of us don't need it, you know? We learn so much stuff in school, and I know because I'm now helping Jordan with his school, right? Because he's a kindergartner, and there's no schools because of COVID-19. We have to school at home. So I'm going through all his homework with him, and he learns so much stuff, even as a kindergartner, right? Now, the stuff he's learning in kindergarten, I remember, but I know that in school, you learn so many things that you will forget, you'll never learn. One of the things that a lot of people I've met have lost touch with is they forget how to calculate percents, add, and they know how to add and subtract, but division and percents and things like that have escaped their mind, right? Exponential growth. I don't know if humans can even comprehend it, honestly. These are the basic things you need to learn, need to master to do money well. And you don't need calculus, although maybe it'll help, but you don't really need it. So I have helped mastermind members refresh their math skills, all right? And there's nothing wrong with that. It's totally fine. It's not something we use every day. So whatever you need to learn to become financially free, I am willing to teach you. And I don't care what your level is, right? I don't care. I'm going to help you. I'm going to help you learn it. I'm going to help you learn the math you need, which is not that hard, but a lot of us are rusty. So I'm going to help you do that. I'm going to help you learn how to be an intelligent investor because I'm learning with Ben Graham, and that comes to today's topic. So as you know, COVID-19 is here, right? COVID-19 is here, and it's pretty challenging, right? We have our children at home with us. Yeah, instead of just them going to school or somewhere or anywhere, and we can't even go many places with them. Luckily, I live near a beach, right? So I can just go outside, jump in the ocean, which is always entertaining. I don't know why. The ocean is great. So that's really lucky for me. And I don't know about you, but COVID-19 has completely changed our lives, right? So it's been a little challenging for me to create the blog posts I usually do where I synthesize all the data and I make it all easy to understand. So that we both learn together, I decided to read a book. That way I would be motivated to still learn, right? And it wasn't too hard because I just had to read, but you could also learn too. And I've never read this book, and this book was on my reading list. I read one book a month on financial stuff. That's why I'm always learning and growing. If you're not learning and growing, you're dying, right? So you need to learn and grow at all times. So this is my book of the month, the last 30 days. And this teacher, Benjamin Graham, taught Warren Buffett. Warren Buffett is a very, very successful investor, right? So if I could do half of what Warren Buffett could do, you know, a quarter, an eighth, you know, it's like a minuscule portion, I would be extremely happy because, dude, Warren Buffett is amazing. And so this book, right, and I've already read Autobiography of Warren Buffett. I've studied some of what he's done, but I've never studied Benjamin Graham till now. So let's do it together. These are actually the last 2 chapters. So I'm really proud of myself for getting this far. And this is all with a 6-year-old at home with me every day. Okay, so let's do this. He might wake up while I'm reading, but this is the inspiration behind these live videos. And the nice thing is you can catch the replays all on yesfinanciallyfree.com. So I'm pretty much almost done reading the entire book. All the readings are there, all right? I plan to do a summary, okay? So I will summarize the book. And I will put it there too. So there is a blog post there. Go to it if you want to refer back to information, if you missed something. Right now, it's mostly just the recordings. I put a little bit of written information, but it will improve over time. All right. And if you want to join a mastermind, yesfinanciallyfree.com. Go there, look on the products page, and all of my products are there. When you get on the email list, you'll see a summary of products at the end of every email. You can reply back to any email. I will respond. So if you have questions, you want to talk to me, I'm there. All right. So let's begin. Stockholders and management's dividend policy. Chapter 19. Ever since 1934, we have argued in our writings for a more intelligent and energetic attitude by stockholders toward their managements. We have asked them to take a generous attitude toward those who are demonstrably doing a good job. We have asked them also to demand clear and satisfying explanations when the results appear to be worse than they should be, and to support movements to improve or remove clear, unproductive management. Excuse me. Whoa. Excuse me. Stockholders are justified in raising questions as to the competence of the management when the results, 1, are unsatisfactory in themselves, and 2, are poorer than those obtained by other companies that appear similarly situated, and 3, have resulted in an unsatisfactory market price of long duration. In the last 36 years, practically nothing has actually been accomplished through intelligent action by the great body of stockholders. A sensible crusader, if there are any such, would take this as a sign that he has been wasting his time and that he had better give up a fight. As it happens, our cause has not been lost. It has been rescued by an extraneous development known as takeovers or takeover bids. We said in Chapter 8 that poor managements produce poor market prices. The low market prices in turn attract the attention of companies interested in diversifying their operations, and these are now legion. Innumerable such acquisitions have been accomplished by agreement with the existing managements, or else by accumulation of shares in the market and by offers made over the head of those in control. The price bid has usually been within the range of the value of the enterprise under reasonably competent management. Hence, in many cases, the inert public stockholder has been bailed out by the actions of outsiders, who at times may be enterprising individuals or groups acting on their own. It can be stated as a rule that with very few exceptions, that poor managements are not changed by action of the public stockholders, but only by the assertion of control by an individual or compact group. This is happening often enough these days to put the management, including the board of directors of a typical publicly controlled company, on notice that if operating results and the resulting market price are highly unsatisfactory, it may become the target of a successful takeover move. As a consequence, boards of directors have probably become more alive than previously to their fundamental duty to see that their company has satisfactory top management. Many more changes of presidents have been seen in recent years than formerly. Not all companies in the unsatisfactory class have benefited from such investments. Also, the change has often occurred after a long period of bad results with remedial action, and has depended on enough disappointed stockholders selling out at low prices to permit the energetic outsiders to acquire a controlling position in the shares. But the idea that public stockholders could really help themselves by supporting moves for improved management and management policies has proved too quixotic. I don't even know how to say that word, Quixotic, to warrant further space in this book. Those individual stockholders who have enough gumption to make their presence felt at annual meetings, generally a completely futile performance, will not need our counsel on what points to raise with management. For others, the advice would probably be wasted. Nevertheless, let us close this section with the plea that stockholders consider with an open mind and with careful attention any proxy material sent them by fellow stockholders who want to remedy an obviously unsatisfactory management situation in the company. Stockholders and dividend policy. In the past, the dividend policy was a fairly frequent subject of argument between public or minority stockholders and management. In general, these stockholders wanted more liberal dividends, while the management preferred to keep the earnings in the business to strengthen the company. They asked the stockholders to sacrifice their present interests for the good of the enterprise and for their own future long-term benefit. But in recent years, the attitude of investors toward dividends has been undergoing a gradual but significant change. The basic argument now for paying small rather than liberal dividends is not that the company needs the money, but rather it can use it to the stockholders' direct and immediate advantage by retaining the funds for profitable expansion. Years ago, it was typically the weak company that was more or less forced to hold on to its profits instead of paying out the usual 60 to 70% of them in dividends. The effect was almost always adverse to the market price of the shares. Nowadays, it is quite likely to be a strong and growing enterprise that deliberately keeps down its dividend payments with the approval of investors and speculators alike. There was always a strong theoretical case for reinvesting profits in the business where such retention could be counted on to produce a goodly increase in earnings. But there were several strong counterarguments, such as the profits belong to the stockholders and they are entitled to have them paid out within the limits of prudent management. Many of the stockholders need their dividend income to live on. The earnings they receive in dividends are real money, while those retained in the company may or may not show up later as tangible values for the stockholders. These counter-arguments were so compelling, in fact, that the stock market showed a persistent bias in favor of the liberal dividend payers as against the companies that paid no dividends or relatively small ones. In the last 20 years, the profitable reinvestment theory has been gaining ground. The better the past record of growth, the readier investors and speculators have become to accept a low payout dividend policy. So much is this true that in many cases of growth favorites the dividend rate. So much is this true that in many cases of growth favorites the dividend rate, or even the absence of any dividend, has seemed to have virtually no effect on the market price. That's like Amazon right now. Amazon pays, I don't know if they pay dividends now, but probably not. They never did before, and now it's COVID-19 and their profits are going down and all that. A striking example of this development is found in the history of Texas Instruments Incorporated. The price of its common stock rose from $5 in 1953 to $256 in 1960, while earnings were advancing from 43 cents to $3.91 per share, while no dividend of any kind was paid. In 1962, cash dividends were initiated, but by that year, the earnings had fallen to $2.14, and the price had shown a spectacular drop to a low of 49. Another extreme illustration is provided by Superior Oil. In 1948, the company reported earnings of $35.26 per share, paid $3 in dividends, and sold as high as $235. In 1953, the dividend was reduced to $1, but the high price was $660. In 1957, it paid no dividends at all and sold at $2,000. This unusual issue later declined to $795 in 1962, when it earned $49.50 and paid $7.50. Investment sentiment is far from crystallized in this matter of dividend policy of growth companies. The conflicting views are well illustrated by the cases of two of our very largest corporations, AT&T, American Telephone and Telegraph, and International Business Machines. American Tel came to be regarded as an issue with good growth possibilities, as shown by the fact that in 1961 it sold at 25 times that year's earnings. Nevertheless, the company's cash dividend policy has remained an investment and speculative consideration of first importance. Its quotation making an active response to even rumors of an impending increase in the dividend rate. On the other hand, comparatively little attention appears to have been paid to the cash dividend on IBM, which in 1960 yielded only 0.5% at the high price of the year and 1.5% at the close of 1970. But in both cases, stock splits have operated as potent stock market influence. The market's appraisal cash dividend policy appears to be developing in the following direction. Where prime emphasis is not placed on growth, stock is rated as an income issue, and the dividend rate retains its long-held importance as the prime determinant of market price. At the other extreme, stocks clearly recognized to be in the rapid growth category valued primarily in terms of the expected growth rate over, say, the next decade, and the cash dividend rate is more or less left out of the reckoning. While the above statement may properly describe present tendencies, it is by no means a clear-cut guide to the situation in all common stocks, and perhaps not in the majority of them. For one thing, many companies occupy an intermediate position between growth and non-growth enterprises. It is hard to say how much importance should be ascribed to the growth factor in such cases, and the market's view thereof may change radically from year to year. Secondly, there seems to be something paradoxical about requiring the companies showing slower growth to be more liberal with their cash dividend. For these are generally the less prosperous concerns, and in the past, the more prosperous the company, the greater was the expectation of both liberal and increasing payments. It is our belief that stockholders should demand of their managements either a normal payout of earnings, or on the other, say, of 2/3, or else a clear-cut demonstration that the reinvested profits have produced a satisfactory increase in per-share earnings. Such a demonstration could ordinarily be made in the case of a recognized growth company, but in many other cases, a low payout is clearly the cause of an average market price that is below fair value, and here the stockholders have every right to inquire and probably complain. A niggardly policy has often been imposed on a company because its financial position is relatively weak, and it has needed all or most of its earnings plus depreciation charges to pay debts and bolster its working capital position. When this is so, there is not much the stockholders can say about it, except perhaps to criticize the management for permitting the company to fall into such an unsatisfactory financial position. However, dividends are sometimes held down by relatively unprosperous companies for the declared purpose of expanding the business. We feel that such a policy is illogical on face value and should require both a complete explanation and a convincing defense before the stockholders should accept it. In terms of the past record, there is no reason a priori to believe that the owners will benefit from expansion moves undertaken with their money by a business showing mediocre results and continuing its old management. Stock dividends and stock splits. It is important that investors understand the essential difference between a stock dividend, properly so called, and a stock split. The latter represents a restatement of the common stock structure, in a typical case by issuing 2 or 3 shares for 1. The new shares are not related to specific earnings reinvested in a specific past period. Its purpose is to establish a low market price for the single shares, presumably because such lower price range would be more acceptable to old and new stockholders. A stock split may be carried out by what technically may be called a stock dividend, which involves a transfer of sums from earned surplus to capital account, or else by a change in par value, which does not affect the surplus account. What we should call a proper stock dividend is one that is paid to stockholders to give them a tangible evidence or representation of specific earnings which have been reinvested in the business for their account over some relatively short period in the recent past, say not more than the 2 preceding years. It is now approved practice to value such a stock dividend at the approximate value at the time of declaration. Okay, sorry, I've been reading and not paying attention. I'm going to go backwards. I apologize. It is important that investors understand the essential difference between a stock dividend, properly so called, and a stock split. Okay, that I understand the difference. The latter represents a restatement of the common stock structure, in a typical case by issuing 2 or 3 shares for 1. Okay, I got that. The new shares are not related to specific earnings reinvested in a specific past period. Its purpose is to establish a lower market price for the single shares, presumably because such lower price range would be more acceptable to old and new stockholders. A stock split may be carried out by what technically may be called a stock dividend, which involves a transfer of sums from earned surplus to capital account, or else by a change in par value, which does not affect the surplus account. What we should call a proper stock dividend is one that is paid to stockholders to give them a tangible evidence or representation of specific earnings which have been reinvested in the business for their account for some relatively short period in the recent past, say not more than 2 preceding years. It is now approved practice to value such a stock dividend at the approximate value at the time of declaration, and to transfer an amount equal to such value from earned surplus to capital accounts. Thus, the amount of typical stock dividend is relatively small, in most cases not more than 5%. In essence, a stock dividend of this sort has the same overall effect as the payment of an equivalent amount of cash out of earnings when accompanied by the sale of additional shares of like total value to the stockholders. However, a straight stock dividend has an important tax advantage over the otherwise equivalent combination of cash dividends with stock subscription rights, which is the almost standard practice for public utility companies. The New York Stock Exchange has set the figure of 25% as a practical dividing line between stock splits and stock dividends. Those of 25% or more need not be accompanied by the transfer of their market value from earned surplus to capital, and so forth. Some companies, especially banks, still follow the old practice of declaring any kind of stock dividend they please, example, one of 10% not related to recent earnings, and these instances maintain an undesirable confusion in the financial world. We have long been a strong advocate of a systematic and clearly enunciated policy with respect to the payment of cash and stock dividends. Under such a policy, stock dividends are paid periodically to capitalize all or a stated portion of the earnings reinvested in the business. Such a policy, covering 100% of the reinvested earnings, has been followed by Purex, government employees insurance, and perhaps a few others. Stock dividends of all types seem to be disapproved of by most academic writers on the subject. They insist that they are nothing but pieces of paper, and that they give the stockholders nothing they did not have before, and that they entail needless expense and inconvenience. On our side, we consider this a completely doctrinaire view, which fails to take into account the practical and psychological realities of investment. True, a periodic stock dividend, say of 5%, changes only the form of the owner's investment. He has 105 shares in place of 100. But without the stock dividend, the original 100 shares would have represented the same ownership interest now embodied in his 105 shares. Nonetheless, the change of form is actually one of real importance and value to him. If he wishes to cash in his share of the reinvested profits, he can do so by selling the new certificate sent to him, instead of having to break up his original certificate. He can count on receiving the same cash dividend rate on 105 shares as formerly on his 100 shares. A 5% rise in the cash dividend rate without the stock dividend would not be nearly as probable. The advantage of a periodic stock dividend policy are more evident when it is compared with the usual practice of the public utility companies of paying liberal cash dividends and then taking back a good part of this money from the stockholders by selling them additional stock through subscription rights. As we mentioned above, the stockholders would find themselves in exactly the same position if they received stock dividends in lieu of the popular combination of cash dividends followed by stock subscriptions, except that they would save the income tax otherwise paid on the cash dividends. Those who need or wish the maximum annual cash income with no additional stock can get this result by selling their stock dividends, in the same way as they sell their subscription rights under present practice. The aggregate amount of income tax that could be saved by substituting stock dividends for the present stock dividends plus subscription rights combination is enormous. We urge that this change be made by the public utilities despite its adverse effect on the U.S. Treasury, because we are convinced that it is completely inequitable to impose a second personal income tax on earnings which are not really received by the stockholders, since the companies take the same money back through the sales of stock. Efficient corporations continuously modernize their facilities, their products, their bookkeeping, their management training programs, their employee relations. It's high time they thought about modernizing their major financial practices, not the least important of which is their dividend policy. Okay, now we're going to Chapter 20. Margin of safety as the central concept of investment. In the old legend, the wise men finally boiled down the history of mortal affairs into the single phrase, "This too will pass." Confronted with a like challenge to distill the secret of sound investment into 3 words, we venture the motto, margin of safety. This is the thread that runs through all the preceding discussion of investment policy, often explicitly, sometimes in a less direct fashion. Let us try now, briefly, to trace that idea in a connected argument. All experienced investors recognize that the margin of safety concept is essential to the choice of sound bonds and preferred stocks. For example, a railroad should have earned its total fixed charges better than 5 times before income tax, taking a period of years for its bonds to qualify as investment grade issues. This past ability to earn in excess of interest requirements constitutes the margin of safety that is counted on to protect the investor against loss or discomfiture in the event of some future decline in net income. The margin above charges may be stated in other ways. For example, in the percentage by which revenues or profits may decline before the balance after interest disappears, but the underlying idea remains the same. The bond investor does not expect future average earnings to work out the same as in the past. If he were sure of that, the margin demanded might be small. Nor does he rely to any controlling extent on his judgment as to whether future earnings will be materially better or poorer than in the past. If he did that, he would have to measure his margin in terms of a carefully projected income account, instead of emphasizing the margin shown in the past record. Here, the function of the margin of safety is, in essence, that of rendering unnecessary and accurate estimate of the future. If the margin is a large one, then it is enough to assume the future earnings will not fall far below those of the past in order for an investor to feel sufficiently protected against the vicissitudes of time. Sorry, let me go back. I don't know what I just read. Okay, okay. My goodness. It's so funny when sometimes you read and you're not paying attention. So I'm going to go back. Sorry, I apologize. I'm going to start from the beginning. Okay, chapter 20, The Intelligent Investor, Benjamin Graham, Margin of Safety as the Central Cost of Investment. In the old legend, the wise men finally boiled down the history of mortal affairs into the single phrase, "This too will pass." It's like COVID-19. This too will pass. Confronted with the like challenge to distill the secret of sound investment into 3 words, we venture the motto, margin of safety. This is the thread that runs through all the preceding discussion of investment policy, often explicitly, sometimes in a less direct fashion. Let us try now briefly to trace that idea in a connected argument. All experienced investors recognize that the margin of safety concept is essential to the choice of sound bonds and preferred stocks. For example, a railroad should have earned its total fixed charges better than 5 times before income tax, taking a period of years for its bonds to qualify as investment grade issues. This past ability to earn in excess of interest requirements constitutes the margin of safety that is counted on to protect the investor against loss or discomfiture in the event of some future decline in net income, like COVID-19. The margin above charges may be stated in other ways. For example, in the percentage by which revenues or profits may decline before the balance after interest disappears, but the underlying idea remains the same. The bond investor does not expect future average earnings to work out the same as in the past. If he were sure of that, the margin demanded might be small. Nor does he rely to any controlling extent on his judgment as to whether future earnings will be materially better or poorer than in the past. If he did that, he would have to measure his margin in terms of a carefully projected income account, instead of emphasizing the margin shown in the past record. Here, the function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. If the margin is a large one, then it is enough to assume that future earnings will not fall far below those of the past in order for an investor to feel sufficiently protected against the vicissitudes of time. The margin of safety for bonds may be calculated alternatively by comparing the total value of the enterprise with the amount of debt. A similar calculation may be made for a preferred stock issue. If the business owes $10 million and is fairly worth $30 million, there is room for a shrinkage of 2/3 in value, at least theoretically, before the bondholders will suffer loss. The amount of this extra value or cushion above the debt may be approximated by using the average market price of the junior stock issues over a period of years. Since average stock prices are generally related to average earnings power, the margin of enterprise value over debt and the margin of earnings over charges will in most cases yield similar results. So much for the margin of safety concept as applied to fixed value investments. Can it be carried over into the field of common stocks? Yes, but with some necessary modifications. There are instances where a common stock may be considered sound because it enjoys a margin of safety as large as that of a good bond. This will occur, for example, when a company has outstanding only common stock that under depression conditions is selling for less than the amount of bonds that could safely be issued against its property and earning power. That was the position of a host of strongly financed industrial companies at the low prices levels of 1932 to 1933. In such instances, the investor can obtain the margin of safety associated with a bond, plus all the chances of larger income and principal appreciation inherent in a common stock. The only thing he lacks is the legal power to insist on dividend payouts or else, and this is a small drawback as compared with his advantages. Common stocks bought under such circumstances will supply an ideal, though infrequent, combination of safety and profit opportunity. As a quite recent example of this condition, let us mention once more National Presto Industries stock, which sold for a total enterprise value of $43 million in 1972. With its $16 million of recent earnings before taxes, the company could easily have supported this amount of bonds. In the ordinary common stock bought for investment under normal conditions, the margin of safety lies in an expected earning power considerably above the going rate for bonds. In former editions, we elucidated this point with the following figures. Assume in a typical case that the earning power of 9% on the price and that the bond rate is 4%. Then the stock buyer will have an average annual margin of 5% accruing in his favor. Some of the excess is paid to him in the dividend rate, even though spent by him, it enters into his overall investment result. The undistributed balance is reinvested in the business from his account. In many cases, such reinvested earnings fail to add commensurately to the earning power and value of his stock. That is why the market has a stubborn habit of valuing earnings dispersed in dividends more generously than the portion retained in the business. But if the picture is viewed as a whole, there is a reasonably close connection between the growth of a corporate surpluses through reinvested earnings and the growth of corporate values. Over a 10-year period, the typical excess of stock earning power over bond interest may aggregate 50% of the price paid. This figure is sufficient to provide a very real margin of safety, which, under favorable conditions, will prevent or minimize a loss. If such a margin is present in each of a diversified list of 20 or more stocks, the probability of a favorable result under fairly normal conditions becomes very large. That is why the policy of investing in representative common stocks does not require high qualities of insight and foresight to work out successfully. If the purchases are made at the average level of the market over a span of years, the prices paid should carry with them assurance of an adequate margin of safety. The danger to investors lies in concentrating their purchases in the upper levels of the market, or in buying non-representative common stocks that carry more than the average risk of diminished earnings power. As we see it, the whole problem of common stock investment under 1972 conditions lies in the fact that in a typical case, the earning power is now much less than 9% on the price paid. Let us assume that by concentrating somewhat on the low multiplier issues among the large companies, a defensive investor may now acquire entities at 12 times recent earnings, i.e. with an earnings return of 8.33% on cost. He may obtain a dividend yield of about 4% and will have 4.33% of his cost reinvested in the business for his account. On this basis, the excess of stock earning power over dividend or bond interest over a 10-year basis would still be too small to constitute an adequate margin of safety. For that reason, we feel that there are real risks now, even in a diversified list of sound common stocks. The risks may be fully offset by the profit possibilities of the list, and indeed the investor may have no choice but to incur them. For otherwise, he may run an even greater risk of holding only fixed claims payable in steadily depreciating dollars. Nonetheless, the investor would do well to recognize and to accept as philosophically as he can that the old package of good profit possibilities combined with the ultimate risk is no longer available to him. However, the risk of paying too high a price for good quality stocks, while a real one, is not the chief hazard confronting the average buyer of securities. Observation over many years has taught us that the chief losses to investors come from the purchase of low quality securities at times of favorable business conditions. The purchasers view the current good earnings as equivalent to earning power and assume that prosperity is synonymous with safety. It is in those years that bonds and preferred stocks of inferior grade can be sold to the public at a price around par because they carry a little higher income return or a deceptively attractive conversion privilege. It is then also that common stocks of obscure companies can be floated at prices far above the tangible investment on the strength of 2 or 3 years of excellent growth. These securities do not offer an adequate margin of safety in any admissible sense of the term. Coverage of interest charges and preferred dividends must be tested over a number of years, including preferably a period of subnormal business, such as in 1970 and 1971. The same is ordinarily true of common stock earnings if they are to qualify as indicators of earnings power. Thus, it follows that most of the fair weather investments acquired at fair weather prices are destined to suffer disturbing price declines when the horizon clouds over, and often sooner than that. Nor can the investor count with confidence on an eventual recovery, although this does come about in some proportion of the cases, for he has never had a real safety margin to tide him through adversity. The philosophy of investment in growth stocks parallels in part contravenes the margin of safety principle. The growth stock buyer relies on an expected earning power that is greater than the average shown in the past. Thus, he may be said to constitute these expected earnings for the past record in calculating his margin of safety. In investment theory, there is no reason why carefully estimated future earnings should be a less reliable guide than the bare record of the past. In fact, security analysis is coming more and more to prefer a competently executed evaluation of the future. Thus, the growth stock approach may supply as dependable a margin of safety as is found in the ordinary investment, provided the calculation of the future is conservatively made and provided it shows a satisfactory margin in relation to the price paid. The danger in a growth stock program lies precisely here. For such favored issues, the market has a tendency to set prices that will not be adequately protected by a conservative projection of future earnings. It is a basic rule of prudent investment that all estimates, when they differ from past performance, must err at least slightly on the side of understatement. The margin of safety is always dependent on the price paid. It will be large at one price, small at some higher price, non-existent at some still higher price. If, as we suggest, the average market level of most growth stocks is too high to provide an adequate margin of safety for the buyer, then a simple technique of diversified buying in this field may not work out satisfactorily. A special degree of foresight and judgment will be needed in order that wise individual selections may overcome the hazards inherent in the customary market level of such issues as a whole. The margin of safety idea becomes much more evident when we apply it to the field of undervalued or bargain securities. We have here, by definition, a favorable difference between price on the one hand and indicated or price value on the other. That difference is the safety margin. It is available for absorbing the effect of miscalculations or worse than average luck. The buyer of bargain issues places particular emphasis on the ability of the investment to withstand adverse developments. for in most such cases, he has no real enthusiasm about the company's prospects. True, if the prospects are definitely bad, the investor will prefer to avoid the security no matter how low the price. But the field of undervalued issues is drawn from the many concerns, perhaps a majority of the total, for which the future appears neither distinctly promising nor distinctly unpromising. If these are bought on a bargain basis, even a moderate decline in the earning power need not prevent the investment from showing satisfactory results. The margin of safety will then have served its proper purpose. Theory of diversification. There is a close logic connection between the concept of a safety margin and the principle of diversification. One is correlation with the other. Even with a margin in the investor's favor, an individual security may work out badly. For the margin guarantees only that he has a better chance for profit than for loss, not that loss is impossible. But as the number of such commitments is increased, the more certain does it become that the aggregate of the profits will exceed the aggregate of the losses. That is the simple basis of the insurance underwriting business. Diversification is an established tenet of conservative investment. By accepting it so universally, investors are really demonstrating their acceptance of the margin of safety principle, to which diversification is the companion. This point may be made more colorful by reference to the arithmetic of roulette. If a man bets $1 on a single number, he is paid $35 profit when he wins, but the chances are 37 to 1 that he will lose. He has a negative margin of safety. In his case, diversification is foolish. The more numbers he bets on, the smaller his chance of ending with a profit. If he regularly bets on $1 on every number, including 0 and 00, he's certainly to lose $2 on each turn of the wheel. But suppose the winner received $39 profit instead of 31. Then he would have a small but important margin of safety. Therefore, the more numbers he wagers on, the better his chance of gain. And he could be certain of winning $2 on every spin by simply betting $1 on all the numbers. Incidentally, the two examples given actually describe the respective positions of the player and proprietor of a wheel with 0 and 00. Not sure what exactly he just said there. And all the numbers. He just said if you bet on all the numbers, you would lose. And then he said if you bet on all the numbers, you would win. So I don't understand his example. Yeah. I understand what he's talking about, a diversity. So I'm just going to skip his example. Okay. The criterion of investment versus speculation. Since there is no single definition of investment in general acceptance, authorities have the right to define it pretty much as they please. Many of them deny that there is any useful or dependable difference between the concepts of investment and of speculation. We think this skepticism is unnecessary and harmful. It is injurious because it lends encouragement to the innate leaning of many people toward the excitement and hazards of stock market speculation. We suggest that the margin of safety concept may be used to advantage as a touchstone to distinguish an investment operation from a speculative one. Probably most speculators believe they have the odds in their favor when they take their chances, and therefore they may lay claim to a safety margin in their proceedings. Each one has the feeling that the time is propitious for his purchase, or that his skill is superior to the crowd's, or that his advisor or system is trustworthy. But such claims are unconvincing. They rest on subjective judgment, unsupported by any body of favorable evidence or any conclusive line of reasoning. We gratefully doubt whether the man who stakes money on his view that the market is heading up or down can ever be said to be protected by a margin of safety in any useful sense of the phrase. By contrast, the investor's concept of the margin of safety, as developed earlier in this chapter, rests upon simple and definite arithmetical reasoning from statistical data. We believe also that it is well supported by practical investment experience. There is no guarantee that this fundamental quantitative approach will continue to show favorable results under the unknown conditions of the future. But equally, there is no valid reason for pessimism on this score. Thus, in sum, we say that to have a true investment, there must be present a true margin of safety, and a margin of safety is one that can be demonstrated by figures, by persuasive reasoning, and by reference to a body of actual experience. Extension of the concept of investment. To complete our discussion of the margin of safety principle, we must now make a further distinction between conventional and unconventional investments. Conventional investments are appropriate for the typical portfolio. Under this heading have always come United States government issues and high-grade dividend-paying common stocks. We have added state and municipal bonds for those who will benefit sufficiently by their tax-exempt features. Also included are high first-quality corporate bonds when, as now, they can be bought to yield sufficiently more than United States savings bonds. Unconventional investments are those that are suitable only for the enterprising investor. They cover a wide range. The broadest category is that of undervalued common stocks of secondary companies, which we recommend for purchase when they can be bought at 2/3 or less than of their indicated value. Besides these, there is often a wide choice of medium-grade corporate bonds and preferred stocks when they are selling at such depressed prices as to be obtainable also at a considerable discount from their apparent value. In these cases, the average investor would be inclined to call the securities speculative, because in his mind their lack of first-rate quality rating is synonymous with lack of investment merit. It is our argument that a sufficiently low price can turn a security of mediocre quality into a sound investment opportunity, provided that the buyer is informed and experienced and that he practices adequate diversification. For if the price is low enough to create a substantial margin of safety, the security thereby meets our criterion of investment. Our favorite supporting illustration is taken from the field of real estate bonds. In the 1920s, billions of dollars worth of these issues were sold at par and widely recommended as sound investments. A large proportion had so little margin of value over debt as to be in fact highly speculative in character. Well, that's funny. That sounds like the real estate crisis. In the Depression of the 1930s, an enormous quantity of these bonds defaulted their interest and their price collapsed, in some cases below 10 cents on the dollar. At that stage, the same advisors who had recommended them at par as safe investments were rejecting them as paper of the most speculative and unattractive type. But as a matter of fact, the price depreciation of about 90% made many of these securities exceedingly attractive and reasonably safe, for the true values behind them were 4 or 5 times the market quotation. The fact that the purchase of these bonds actually resulted in what is generally called a large speculative profit did not prevent them from having true investment qualities at their low prices. The speculative profit was the purchaser's reward for having made an unusually shrewd investment. They could properly be called investment opportunities, since a careful analysis would have shown that the excess of value over price provided a large margin of safety. Thus, the very class of fair-weather investments which we stated above as a chief source of serious loss to naive security buyers is likely to afford many sound profit opportunities to the sophisticated operator who may buy them later at pretty much his own price. The whole field of special situations could come under our definition of investment operations because the purchase is always predicated on a thoroughgoing analysis that promises a larger realization than the price paid. Again, there are risk factors in each individual case, but these are allowed for in the calculations and absorbed in the overall results of a diversified operation. To carry this discussion to a logical extreme, we might suggest that a defensive investment operation could be set up by buying such intangible values as we are represented by a group of common stock option warrants, selling at historically low prices. This example is intended as somewhat of a shocker. The entire value of these warrants rests on the possibility that the related stocks may someday advance above the option price. At the moment, they have no exercisable value. Hold on. The whole field of special situations would come under our definition of investment operations because the purchase is always predicated on a thoroughgoing analysis that promises a larger realization than the price paid. Again, there are risk factors in each individual case, but these are allowed for in the calculations and absorbed in the overall results in a diversified operation. To carry this discussion to a logical extreme, we might suggest that a defensible investment operation could be set up by buying such intangible values as are represented by a group of common stock option warrants, selling at historically low prices. This example is intended as somewhat of a shocker. The entire value of these warrants rests on the possibility that the related stocks may someday advance above the option price. At the moment, they have no exercisable value, yet, since all investment rests on reasonable future expectations, it is proper to view these warrants in terms of the mathematical chances that some future bull market will create a large increase in their indicated value and in their price. Such a study might well yield the conclusion that there is much more to be gained in such an operation than to be lost, and that the chances of an ultimate profit are much better than those of an ultimate loss. If that is so, there is a safety margin present even in this unprepossessing security form. Sufficiently enterprising investor could then include an option warrant operation in his miscellany of unconventional investments. This argument is supported by Paul Hallenby Jr., Speculative Opportunities in Stock Purchase Warrants, Analyst Journal, 3rd quarter, 1947. To sum up, investment is most intelligent when it is most businesslike. It is amazing to see how many capable businessmen try to operate in Wall Street with complete disregard of all the sound principles through which they have gained success in their own undertakings. Yet even corporate security may best be viewed, in the first instance, as an ownership interest in or a claim against a specific business enterprise. And if a person sets out to make profits from security purchases and sales, he is embarking on a business venture of his own, which must be run in accordance with accepted business principles if it is to have a chance of success. The first and most obvious of these principles is know what you are doing, know your business. For the investor, this means do not try to make business profits out of securities. That is, returns in excess of normal interest and dividend income, unless you know as much about security values as you would need to know about the value of merchandise that you propose to manufacture or deal in. Second business principle, do not let anyone else run your business unless, 1, you can supervise his performance with adequate care and comprehension, and 2, you have unusually strong reasons for placing implicit confidence in his integrity and ability. For the investor, this rule should determine the conditions under which he will permit someone else to decide what is done with his money. A third business principle, do not enter upon an operation that is manufacturing or trading in an item unless a reliable calculation shows that it has a fair chance to yield a reasonable profit. In particular, keep away from ventures in which you have little to gain and much to lose. For the enterprising investor, this means that his operations for profit should be based not on an optimism but on arithmetic. For every investor, it means that when he limits his return to a small figure, as formerly, at least in a conventional bond or preferred stock, he must demand convincing evidence that he is not risking a substantial part of his principal. The fourth business rule is more positive. Have the courage of your knowledge and experience. If you have formed a conclusion from the facts, and if you know your judgment is sound, act on it, even though others may hesitate or differ. You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Similarly, in the world of securities, courage becomes a supreme virtue after adequate knowledge and a tested judgment are at hand. Fortunately, for the typical investor, it is by no means necessary for his success that he bring these qualities to bear upon his program, provided he limits his ambition to his capacity and confines his activities within the safe and narrow path of standard defensive investment. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. Okay, let me just go through that again. 1, know what you are doing, know your business. 2, don't let anyone else run your business. 3, do not enter upon an operation unless a reliable calculation shows that it has a fair chance to yield a reasonable profit. Okay. 4, have the courage of your knowledge and experience. If you have formed a conclusion from the facts and if you know your judgment is sound, act on it, even though others may hesitate or differ. There you go. And that is the end of all the chapters. There is a postscript. I might read that on Monday. But thank you so much for being on this live. This was chapter 19 and 20 of The Intelligent Investor by Benjamin Graham. 19 was Stockholders and Management Dividend Policy. 20 was Margin of Safety as the control concept of investment. And central concept of investment. My name again is May Duldalau. The blog is yesfinanciallyfree.com. If you're not a subscriber on YouTube, go ahead and subscribe. On Instagram, thank you so much. Go check out the link in the profile. There's a link on YouTube as well to the blog post with all the videos. Leave a comment. Let me know how I'm doing. Thank you so much for being on the live. Aloha and take care. Bye.